Good afternoon, everyone, and welcome to the Monday Open presented by the Vantage Markets Australia private client team. My name's Jeff. I'm in our Sydney office, and on that team, I'm usually joined by Mark from Melbourne, but he's a little bit under the weather today, so I shall be running this myself. We will be doing it in the normal strategy, which is the way that we normally do it. We will go through the market events of last week. We'll talk a little bit about what's happening or what's on the agenda for this week. We'll do a little bit of technical analysis, and then we'll have some Q&As at the end. So nice and simple, nice and to the point. So last week was a little bit all about the US dollar. We had a lot of data come out that was really quite key. We had the CPI and PPI data. The PPI is the producer prices number that feeds into CPI. So those two numbers both came in higher than expected, and they supported the dollar. We also had US initial claims. They pretty much came in close to expectations. They were actually a lot closer to expectations than they usually are. So maybe some of those bank economists are starting to earn their salaries. And then on Friday, we had the US retail sales print weaker than expected. So early on in the week, with the CPI and PPI numbers being strong, that was supportive for the US dollar. The initial claims was pretty much ignored, and then on Friday we saw a little bit of dollar weakness after the weak retail sales. Over and above all of this is the tariff backwards and forwards comments from Trump. Tariffs on this, tariffs on that, 25% tariff on steel and aluminium. Nothing's been actually formally announced or written into law yet. It looks like April is when they're going to actually come in, if at all. The growing feeling in the market is that he's actually using the threat of tariffs more as a bargaining chip to get the other stuff that he wants more than tariffs themselves. So there's a pretty good chance, I think the market is thinking, that tariffs won't eventuate. If they do, what will happen is that the other side of the equation, so US is putting a 25% tariff on Canada. Canada will do the same thing, and it will net pretty much do nothing other than increase prices in the US for everything that there's a tariff on. So obviously those increase in prices are passed on to consumers, and the competitors, even the local competitors, will increase their prices to match the offshore providers, because that's a little phrase in economics they call maximizing their utility. This week's a little bit more local. We've got RBA rate announcement on Tuesday. I've got expect no change because I expect no change. The market is expecting a 25 basis points cut there. I don't think they're going to do anything. I think Michelle Bullock will actually do nothing again. On Wednesday, the Reserve Bank of New Zealand will announce on rates. The market is also expecting a 25 basis points cut from New Zealand. I'm a little bit less sure about this one. I think the Kiwis might actually do something, but I think on the whole they've done plenty. They've done enough, and their rates are low enough to be comfortable. I think there'll be no change there. On Thursday, locally, we've got some unemployment numbers coming out of Australia. I think those numbers, I've just got an inkling that they're going to be a little bit stronger than what the market's expecting. If that was the case, expect the dollar to be really quite supported by that. No rate announcement in either Australia or New Zealand would support the local currencies as well, because we go back to something we've been talking about for a little while, which is lower interest rates are bearish for currencies. So that's this week. Obviously, tariff talk as well. So there'll be the themes over the course of the week. On the technical analysis, I've done it a little bit differently to Mark. I don't use a lot of indicators, and I like to, do things my way that I've been doing for a very, very long time. This chart here is gold versus the US dollar. Most of the Forex brokers, and us included, will have gold against other currencies as well, but it's pretty much squarely quoted against the US dollar. What I found, this is a daily chart, and gold incidentally rose last year by about 26%. It was, I think, the best or the second best performing asset class in the world of all asset classes. And it just doesn't look like it's going to stop anytime soon. So what I've noticed on this chart is you've got that supportive trend line on the dailies, which comes in from pretty much all this year. That's currently looking at around 28.37.5. So I would expect some pretty good support for any dips towards that level or towards that line as that continues to trend upwards. The historical now high of 29.42.5 will act as a little bit of resistance. You can't see because my head's over the chart, but what Stochastic has done is it's come back down to that line you could see, which has been a reversal line twice before. It's actually kissing that level now. I think that what gold will do over the course of this week is go sideways, which is great, but actually quite useful, because if you can get a long position somewhere between now and between that bullish trend line with stops below that trend line, I think that might be a really good trade. I'd then be looking to kind of reduce the position on the approach to that historical high at 92.42.5, but hold some, because when it does break, it's probably going to go higher. I think in January I was saying that gold will get to 3,000 by Easter. I think we're probably going to get there way before, and Easter's early this year. That's gold. I also, for something a little bit different, wanted to throw this one in. And I wanted to throw this one in because it's going sideways. This is copper, and it's a weekly copper chart. You can see that price has been pretty much held within an 80-cent range since the middle of last year. I don't use a lot of indicators, but I do like sideways support levels. What I can see is that the recent, or the late last year, the last dip failed to touch the prior dip, which is at $3.90. So that looked bullish from there. I can also see that prices nudged above the $4.70 a pound, I think, level. It's closed below that level, but is still holding really quite close. To me, this looks like it wants to break higher. It wants to trade higher. The retracements are getting a lot more shallow than the previous ones, and just the upward movements are a little bit more impulsive. I would be looking for this one to be kind of buying on a dip buying mentality, targeting first that high from last week, and then after that the prior high before then, which comes in just south of $5.20. And I mean, that's a pretty big move, and with leverage on these sorts of commodities, that would be a nice little reward for the account. Obviously, if it goes below $3.90, we're all wrong. $3.90 looks like it's going to be very, very supportive, at least for the near term. You can see it was also a prior high before that last impulsive spike higher. That sort of level is going to be really quite important. But again, I'd be comfortable to be buying dips. If it did fail from here and fall back down towards that bottom of the range, I'd be looking to scoop up some in the low $4 with stops below about $3.90. So we usually do some questions and answers. We get questions from clients that we speak to over the week, and we like to share those with a broader audience. This week, I'm just doing one because it's just me. What is a top-down analysis approach? So top-down analysis can be done either fundamentally or with technical analysis, and I'll go through both. The fundamental one, is to look at economic data that is broad. And by broad, we talk GDP, we talk employment and inflation. The other one I'd throw in there that's a little bit different to what most economists would do is that I'd throw in interest rates and interest rate magnitude. So where an interest rate is in and of itself is just a number. But what is it doing? What has it done? So interest rates are falling. Generally, for a currency, that's a bad thing. For an equity market, it's generally a good thing. So when interest rates fall, or if interest rates were to fall in Australia on Tuesday tomorrow, I would expect that the Aussie dollar would probably get hit a little bit, and the Aussie equity market would rise. Equity markets are tending to move more in line with what's happening in the US. That's been a trend that's been going on for the last 10 or 15 years. But an interest rate hike here would probably have a knee-jerk reaction to support the equity market. An interest rate rise would then also support bonds, because bonds with a higher coupon would be more valuable than new bonds that will be launched at a lower coupon because official rates will be lower. But let's not talk about bonds. There was some talk that one of our clients from one of the other actual AMs wanted to know a little bit about what the fundamentals are of gold. So I'll talk a little bit about that as well. The big players in gold over the last 2 or 3 years have been the central banks. India has been a very big buyer of gold. China has been a very big buyer of gold. Bangladesh has also been a very big buyer of gold. There was a lot of talk in the press towards the end of last year that cryptocurrencies might become a little bit more useful and replace gold as a reserve asset for these central banks. The chances of that, I think, longer term are about 3%. The chances of that short term are close to zero. Can't say zero, but close to zero. I think what will happen is that you'll find that central banks will understand that the current environment for gold, and I'll just back up to where that is on the chart. The current environment for gold at around $3,000 an ounce isn't going to go away anytime soon. I think the fast money funds, the momentum funds, will be very keen to buy dips. It will be flagging every single algo in terms of in a bullish trend. So any sort of weakness on that will probably see some good dip buying. And then obviously if it doesn't fall to any decent lower level, say 2.5 or even 2, I'd say the central banks will probably come in and start buying more. So I think over the course of this year, I think gold is going to be really quite bullish. I think we're going to get to 3,000 in pretty quickly, and I think by the end of the year we could be closer to 4.5. As much gold as there is on this planet is as much gold as there is, and you can't really increase supply. You can increase the speed that you're digging it out of the planet, but there's only a limited supply of what there is actually in there. So I think as a hard asset, gold ticks the boxes and will remain firm. So that's it for us this week, or for me this week. This video will be uploaded to our YouTube channel and to our VIP trading room. Please also note that within that VIP trading room for all of our clients, you'll find a lot of resources in there as well. We have our weekly technical video that gets uploaded there every Monday. I'm logged in there all day, so you can ask me questions directly without having to get on the phone if that suits you better. We also do our daily update every morning that is uploaded to that, or can be emailed to you. If you do want to have it emailed to you, just simply reach out and let me know, and we'll have you added to the list. And that pretty much does it for today. So thank you very much for your time, everyone, and hopefully you'll see me and Mark next Monday.